You are listening to Keystone's Stock Talk Show, episode 202.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to be back with you following a busy week and a down week for the markets. We will start by chatting about the big financial story of the past week that's heading into this week, the collapse of tech banker Silicon Valley Bank, which is traded under the symbol SIVB on the NASDAQ. The failure marks the second largest in U.S. history by a number of measures. We will look at why and what the fallout may be. Brett will take a look at that for us just momentarily. In our Your Stock Our Take segment, I will start with a look at long-term recommendation XPEL Inc., symbol XPEL on the NASDAQ, a leading provider of protective films, coatings, including automated paint protection film, surface protection film, automotive and architectural window films, and ceramic coatings. A listener who bought the stock in the $2 range on our recommendation asks us if the pullback at the end of February and into March from the $80 range to $65 today is a time to add more. Brennan answers a viewer question on Tricon Residential, TCN on the TSX, a rental housing company focused on servicing the middle market demographic. The viewer noted that it appears to be trading at a discount to peers with an acceptable balance sheet and tailwinds at their back with housing shortages and massive immigration inflows. Brennan will let you know his thoughts after examining the company. All right, let's get to the show. I'm going to welcome my co-host in what sure is to be the top-rated show of the year so far. I welcome Brennan and Brett, the Killer Bees. How are you guys doing?
Doing well.
It's looking a lot better in here. Yeah,
it is. And why would I say that this might be the highest rated show of the week? Is something missing from the show, or is it addition via subtraction? Well, Aaron Dunn, Mr. Dunn, has boarded the family jet. He's off to Chile for a couple of weeks. We sent him there. We couldn't stand him around the office anymore. Really, we're paying for everything just to get him the hell out of here. So we'll see if this week ranks the highest, but my predictions always come true. So of course it will.
I thought you were.
How are you guys doing?
I thought you were going to say that he was traveling around in a van with as the Partridge Family. Is it the Partridge Family that you usually?
It can be, yeah, the Partridge Family. I've said that before. It's tough to get into a van and get down to Chile from Vancouver. He has wings on one of those vans, but those are just stenciled on the side, right? So now he needs the luxury family jet that they board where they fly all over the world. This time it's Chile.
But yeah, doing well.
Good, yeah. Big news. Well, we just finished up we had 3 seminars last week, so busy week. Brennan was losing it around the office. He couldn't handle it. This is regularly a chipper young man, was just an ornery SOB last week. We're kidding.
I don't know if Brennan, you are kidding. I don't blame you.
He frowned twice. That means he's ornery, right? So that literally happened. So no, Brennan's a happy guy at the best of times. So last week when he frowned, we thought maybe the sky was falling. But it was a busy week. Interacted with 500 clients. We had a VIP event that went on the weekend. We had Tuesday and Thursday the individual seminars. That was great. So it was good to do that virtually. In the fall, we'll probably get out and shake hands with some VIP clients. But it was good to see.
Yeah,
Brennan
it was great.
Did a little presentation. How was it, Brennan? Were the
good.
Nerves there?
No, wasn't nervous. You asked me, would I rather be in front of a crowd or doing it, in front of a computer? I honestly think I'd rather be in front of the crowd. To be completely honest. I mean, the nerves are almost the same, but it's just nice to get that feedback from the audience, you know? So, because I don't know how they're judging me when I'm looking at the you know, just my camera.
Oh, and they are judging you, trust me.
Oh, probably. But at least when I'm, you know, in front of them, you know, I can tell on their face exactly how they're judging me.
You can see the hate in their eyes.
Exactly.
Right when
he's still riding his high from that joke. He said a joke, which, he had a big joke and got a big laugh in Vancouver about 6 months ago, and he's still riding that. But then 2 days later, he was in Calgary and no laughs, and he's still just broken from that.
It rattled him. He's still been rattled since that point. But I it's funny because sometimes you present, and it's because I was just discussing this with you a couple days before, because you were, you know, presenting in front of an audience.
My first time with you guys.
First time, with us. So I said, you know, sometimes the exact same joke in one room goes over just tremendously well, and then it goes over like a fart in church in the next room you're in, right? And it's crickets, and you have to be ready for that, or either make a joke that you know, the last time you presented this way, everybody laughed. I don't know what's wrong with me, or, you know, make fun of yourself. Brennan, it happened to him 2 days later, and it's tough, right? You get rattled.
It was pretty funny, you know, like after
you
Vancouver,
end up laughing at yourself, right?
Of course. But, you know, after Vancouver, I thought I was the funniest man alive. And, you know, all of a sudden Calgary, it brought me down to earth. So, you know.
It's true.
We don't laugh out here.
No, I guess. No.
It's a very serious crowd. Very serious. No, it was a great crowd when we were in Calgary too, as well.
But yeah, you know, Sunday as well. Just this past Sunday, how long was the chat session that we did with, or the Q&A session we did with VIP?
45 minutes after. 45 minutes. With VIP. That was with new VIP clients that we were onboarding there. So that was great. And you can find that. Well. Our VIP clients can see that, the 40 minutes there, if you want to take a look at that. Some good questions on a bunch of companies in our VIP high conviction portfolio. So that was good. It was good to get that all through, and now we're on to some great research, which is good to see again. But this week, big news: Silicon Valley Bank, the largest failure of a financial institution, I believe, since Washington Mutual collapsed at the height of the financial crisis more than a decade ago, and it had some immediate effects. So, Brett, do you want to take it away, get into that? You got a little presentation you've got that you want to talk about, probably?
No,
you got nothing, do you?
No, I don't have slides this time. No, I don't have slides this time, and he's
good.
Typing that up, and
nobody wants to look at slides.
Well, they don't get to see them, but I have clips and stuff lined up for the actual viewers.
Awesome.
And I will qualify. It was the second largest bank in U.S. history, but that doesn't count like investment banks, which we call them. Those are technically financial service. So Lehman Brothers in 2008, and I think Bear Stearns was actually bigger than this as well. Both of those are financial services. They don't count as banks, even though we all call them investment banks. Just to put that out there.
Okay.
I know. Yeah. It doesn't count. Yeah. Just for bank failures, you know, just to bring them down a bit. But Silicon Valley Bank is the bank which we're going to be talking about here primarily. Formerly, I'm going to say, because they are going to end up being delisted at this time. They're just technically halted. They were symbol SIVB on the NASDAQ. So if you look that up, you can see the previous stock performance. It went from about 200 trading on a Thursday or Wednesday to 100 on the Thursday. And then now it's halted at about that $100 mark. But first, we'll go through the timeline of the event. Mid last week, Moody's, which is a credit rating agency, looked to downgrade the company's rating, which obviously in retrospect is pretty well done on a downgrade, which it should have probably been lower beforehand. Ratings like this are used by third parties to look at banks and other major depositors. So if you're loaning out money to them, you want to say, hey, they're AA, I'll give them this rate. If they're only a C, you'll give them a higher rate or higher rate demanded. So you might require like the LIBOR rate, or I guess it's not LIBOR anymore, but plus spread. So might be 1% for AA, it might be 5% for C. So banks and other companies would want to keep the ratings high as possible to keep the cost down. So as the downgrade was pending, the bank, which I should say it was pending because the bank's portfolio was severely impaired because of rising interest rates. When a bank's core operations is taking in deposits and loaning out money, interest rates will rise the rates of their loans, and as well as securities. and it will decrease values as interest rates decrease. Aaron recently went over this interaction recently, and I'll put a link to that in the description. On Wednesday, March 8th, SVB tried to raise capital to stop the small to notch downgrade. They were expecting at least one, but you want to stop a substantial decrease in rating. The company was looking to raise just over $2.2 billion in capital by selling stock. They had a non-committed private placement. So non-committed pretty much means they're involved, but they aren't legally obligated to buy at that point. And they have $500 million of that lined up. But this is where the market really took notice. Thursday the 9th, stock on opening plunged 60%. So Goldman Sachs bankers at this time were still putting together the deal, hoping to get about $95 per share. So that's still under half of what they were initially expecting on a per share basis. But as news spread of the risk and the depositors quickly withdrew, it started a bank run. Depositors just quickly, more and more, fell out. They were pulling out as much money as they could. This caused any potential stock placement to hold the bank together just to fall apart. Now on Friday, after the max exodus of depositors and their funds just completely withdrew, the placement failed as well. SVB had more deposits than assets backing them, effectively causing the bank to be both illiquid and insolvent at this time. So the FDIC, commonly known as, or the Federal Deposit Insurance Company, commonly known as the FDIC, wiped out all the bank equity, all the common and preferred stock, and as well, but not guaranteed the corporate debt holders. But at this point, it looks like they're not going to be getting even pennies back on the dollar. In other words, Wall Street got wiped out in this case. On Sunday, the FDIC guaranteed all deposits past the usual 250,000 insurance limit, meaning all depositors would be made whole. Only 2.7% of the deposits were insured under the standard limit. At this point, I'll stress that if the FDIC did not do this, it would most likely cause a significant contagion event as other banks will start seeing depositors pull out, causing multiple bank runs, which we've already actually seen one additional one with SBY on Sunday. And if they were to not do this, you'd see more meltdown, and you'd likely see this hit the broad financial market and then into the real market. So your companies would start to fall apart. They can't meet payroll. So all those startups and all the other tech companies that were using SVB as their bank, they can't hit payroll next week. So people quit, people lose their jobs, they can't pay their mortgages, and you see how it plays out there. You'd have another 08-09 financial crisis if they don't do anything. Obviously, that could play in the Fed playbook since inflation is no longer a worry at that point. You see demand being crushed. But that's way worse. That's a super hard landing. That's not even a landing. That's a crash. So obviously, the government, they've released statements. They actually had a Congress meeting last night, and they needed to do something. So if you are in the US, this wasn't your money bailing them out yet. This was the bank's money indirectly. So I will put that out there because I've seen people saying it's a government bailout. It's not. It's still bailout, but not a government bailout. So and at this time, the FDIC is looking for purchasers. The UK branches were already taken over by HSBC for a grand total of £1. There's your buyout to buy a bank. So if you had £1 on you, you could have bought a bank. That's not really how it works. That's a bit of me being a bit facetious about it, but it's pretty much what it's done is the large banks have enough liquidity to support these short-term deposits, but they're absorbing the risk. But in exchange, they have the long-term potential of gaining their own portfolio sizes increased, and as well as their own customer base. So really, what was the underlying issue here? As much as I would like to attribute it to the collapse to Jim Cramer's bullish remarks last month,
I think the fears were not justified. It's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away.
The collapse is really due to fundamental issues. The biggest issue at play here, there were a couple, but I'm going to really focus on this one because they all revolve around it, was a mismatch of duration between the assets and liabilities. So when banks take in deposits and lend them out, like mortgages or investing securities like treasury bills, they're commonly called risk-free for those, but they're only default risk-frees. Because the government cannot default on them really, they can, but for the most part, you expect them not to. They'll just keep on printing money. And I know this is going to confuse people. When I say printing money, they're increasing monetary limits. So as they are sensitive to interest rates, they'll eat these risk-free bonds and loans. They will be sensitive to interest rates, and this is called duration. well, effective duration, I should say. That's the specific type of duration here. So for banks, if you don't want to see the negative impacts of interest rate changes or duration, they will want to match their asset portfolio with their liabilities, and liabilities in this case are the depositors. Effectively, money in via interest rate and money out via interest change at the same pace when your interest rates go down or up. Matching duration is called immunization, and this practice is very common. SVB did not do this. And I'll quickly address a few comments which I've seen rolling around the internet and common takes I've seen. It's the Fed's fault for raising interest rates. They caused the bank to collapse. Frankly, this is just a poor opinion. It's very dumbed down. Bank operations are directly linked to the change in interest rates. But there are many, many, many ways they can negate this risk. Like I said, they can immunize their portfolio. You can do this through interest rate swaps, which is trillions and trillions of dollars traded in notional value. It's not a hard position to get into, and it completely wipes out this risk. And they should be aware of this. But that being said, they didn't have a chief risk officer who would be responsible for this. They had 8 months without a chief risk officer. So if they just completely ignored it, this would be why. Because it would be right during that time. This was from April 2022 to the start of 2023, where these interest rate increases were taking place. If they were just not paying attention, there you go. Like, that's just a complete organizational failure at this point. If the CFO wasn't looking over it, the CEO, because normally if you have a sudden departure, you'd have someone step into that role. Clearly not. They weren't looking at it. Like, that's just an utter failure of this specific company. And as well, like I was saying, there was SBOI, which failed, which was Signature Bank. They as well had similar, most likely, issues. They weren't paying attention to the risk. The next comment I'll address is this was due to it holding crypto companies as depositors. Yes, they had high risk depositors, but the depositors weren't defaulting. They just had deposits in the bank. And this was nothing to do with the issue. If it was their loan portfolio failing, yes, but that's not the issue here. It was a duration mismatch. So purely it was just the banks not managing their duration risk, their interest rate risk, whatever you want to call it in this case. There's slightly different, but I'm not going to play semantics because it would have been the same thing at the end of the day. So not a crypto issue. It was just them failing to manage the risk. Lastly, I'll add, this risk is not over. We're recording this on Monday the 13th. Two more banks, the First Republic Bank and Western Alliance Bank, have both seen their stocks fall roughly 60% and 45% respectively. So it's most likely not over. We might see a couple more defaults. We might see a couple more FDIC takeovers, both having large unsecured deposit base like SVB and Signature. That's the risk which we're seeing at play here, which the people are targeting into withdrawal. And even strong banks ultimately can be taken out by bank runs, but the weakest will fall first. I want to emphasize that. So when you're complaining that the FDIC is now insuring what should have been uninsured deposits, this can happen to banks that were otherwise fine. Bank runs can affect any bank, not just ones that are poorly run like these. These were poorly run banks, obviously, but they wouldn't be the last if the bank runs are just keep on going. So I'll open it up to you guys here.
Awesome.
Yeah, no, it's a good summary. It's funny because you noted that on Wednesday, March 8th, SVB tried to raise capital. It's traditionally a day when I am trying to raise capital, as it's Candace's birthday that day. So every year I'm reaching out to try to cover the presents that she is paying for herself, right, on that day. But I'm kidding, actually. She doesn't do that. That day, but regardless, no, yeah, it's something to watch. Like I think you were saying, generally speaking, when the Federal Reserve rates were near zero, banks were stocked up on long-term, low-risk treasuries. How are interest rates, nasty interest rate hikes? I mean, it's the value of those assets gradually reduced, leaving banks, sometimes sitting on losses. But in this case, it's something to look at when you're looking at banks. But this really does look like company-specific risk that went on poorly managed banks. And, you can have any business that's poorly managed. Banks tend to involve, the entire community around that area, or, if it's a regional bank, if it's larger, so there can be more of an impact. So a business fails if it's poorly run. In this case, it has more of an impact, but business poorly run, failing. And like you said, the point is, a bank run is going to hit these poorly run banks first. If there is further, it can be an issue for a well-run bank, and that could be an issue. I don't think we're seeing that right now.
No, I don't think we're going to see, like, you're not going to see like the big 5 US banks fall apart. You're not going to see JP Morgan and Chase just fall apart overnight. They're actually backing some of these guys out, which it is actually a play for some of these larger banks. They'll look to buy them out. Like I said, the UK branches got sold for £1. If you could buy and weather the storm. And that's the thing. It's actually an opportunity for these guys.
Well, SVB has a large asset management business too. Like there's going to be opportunities there to gain clients, and if you just are smartly able to swoop in at the right moment, you're probably going to pick up some plum assets at some really bargain basement prices. So I mean, it becomes an opportunity. But like you said, that is crazy. They didn't have a risk officer. I mean, you're seeing some of these things play out, like with Sam Bankman-Fried's company, like there basically no risk. Money was so free in so many that you didn't have the checks and balances in place in these companies, which seems asinine, particularly with the size of the money we're talking about in like those 2 failures. It's unbelievable that you can't have basic risk assessment and basic risk controls in place. And it looks like in both of these, that wasn't in place, which is shocking, but you see it from time to time.
Yeah. Like I love, like right now, the internet is just absolutely eating it up. Wow. That Joseph Gentile, who was the chief administrative officer at SVB. Well, his background essentially, and it's kind of funny, or at least I think that it's interesting that the internet's pointing it out, is prior to joining SVB, he was working for the Lehman Brothers, and he ended up retiring. He was the CFO for the Lehman Brothers, and he ended up leaving Lehman Brothers in 2007. So literally right before, the crash and Lehman Brothers obviously getting taken out or, going bankrupt. And then as well, he ended up starting his career at Arthur Andersen, which is the company that ended up doing the auditing for Enron, from my understanding. And I mean, I'm not saying that the reason this bank
basically anywhere this guy goes next, get the hell out of there. That's what you're saying, right? That's what you're trying to say.
The internet's undefeated. It's kind of funny. Yeah. I'm sorry for laughing. People lost money. It's not a funny matter, but I just love that the internet, pulls this up. They're putting this guy's face everywhere and, just saying, well, wherever this guy goes, exactly what you just said, Ryan, wherever this guy goes, you should just avoid. So yeah, I think that's kind of funny.
Well, jokes aside, like I think it is a good thing to look deep into these management teams because they actually did this was a regular share sale, but they sold millions in stock the day before what they were going to sell their capital raise. So that's a bit questionable to say the least.
There's going to be a debate about those planned sales, right? They had this. I think it was the CEO, was it not?
CEO, CFO. Sale. I think it was an entire C-suite.
Yeah. So and the question is, did they know about the capital raise coming? And I would say yes, it happened within a very short period of time after. You have an idea of what's going on. I know. Should that be allowed? It's predetermined, but should it be stopped then? Because you're gonna. I mean, clearly it was millions of dollars, right? That they put in their pockets right before the equity is wiped out completely. So strange. Yeah, and I think that may be talked about, and those type of plans kind of maybe revisited when you look at. I mean, these aren't everyday occurrences that a bank failing like that. So but you can't make policy based on potentially occurrences that are very rare. But in this case, it's really bad luck that somebody's cashing out right ahead of that. Yeah, I read an article on that too as well, and it makes you sit back.
They pay bonuses as well, which was another thing.
All of that, you could go in the compensation. Anyways, I don't think we have enough time. No. We'll go on and on about that. Yeah. All right. Let's move on. That was a good summary, and we'll continue to watch that story, see if there is any fallout. Even the Canadian banks this morning were hit, right? And, kind of recovering.
Yeah, definitely some negative sentiment
by midday. Yeah, but some negative sentiment in that segment. Okay, I'm going to look at a company that should be no stranger to our client base, even to just our listeners on here. XPEL Inc., symbol XPEL in NASDAQ. Originally was a buy from Keystone in 2017 at $1.42. Many times since we've recommended it. It trades at 64, 54. It's up over 3,200% since then. Now, market cap right now, 1.78 billion. Back to when the recommendation was 37 million. So 37 million to 1.78 billion. It's been quite the ride. What does XPEL do to produce all those returns? Well, it's a pretty boring business, but there's just great growth here, which is what we like. They're a provider of protective films and coatings, including automotive paint, protection film, surface protection film, automotive and architectural window films, and ceramic coatings. So that coating that goes on your car, that ceramic coating that protects it from those annoying scratches and dings you get from rock chips or rocks that flip up and hit your car, or somebody puts their keys against your car, that kind of self-healing film. Why the recent drop? This is the question. There was a recent drop in the share price. Strong run to start 2023 as the markets inexplicitly really rallied broadly. Bit of a dead cat bounce, but XPEL dropped in late February from its near-term high range of $78 or $77 to $80 in that range, following its Q2 results that once again produced growth, but not to the level the market and a couple of analysts that are finally following the stock had expected. Q4 highlights here: about 11.9% growth in revenues to $78.5 million compared to the fourth quarter of 2021. Annual growth, however, was in the range of 25%, so Q4 tracked lower growth. Net income increased 34.7% still to $8.4 million, 30 cents per share, up from 22 cents in the same period last year. So good, solid growth there. EBITDA was 32% higher in the quarter. The Q4 was a miss from the guidance that was out there about the guidance, or sorry, not the guidance, the estimates that were out there. 30 cents per share, missed by about 14 cents. Revenues of $78.4 million, again, up 11.9%, but missed by about $5.64 million on the estimates that were out there. Now, there was some good explanation provided by management on the shortfalls in the quarter. Revenue was negatively impacted by about $3.5 million, resulting from the cancellation of some China orders due to uncertainty created by the change in COVID policy, the sudden restart or reopening of the Chinese economy. To contextualize this, XPEL's Q4 business in China is a strong quarter. The rest of the world, it's sequentially slower for the business. So the shock in China really hit hard in a quarter, which is typically a big period and powered kind of by the results and the business in China there. The company also incurred about $400,000 in inventory write-ups, which negatively impacted gross margin. SG&A were negatively impacted by about $300,000. There was another $400,000 in severance-related compensation. So some one-time numbers in the quarter there. If you normalize out those items, revenue would have grown around 17%, and the EBITDA margin would have been approximately 18%. EPS would have been approximately 36 cents per share, up from 30. So the growth would have looked significantly better if you normalize out those one-time items. Now, outlook, they have some general outlook going into Q1. Management stated automakers seem cautiously optimistic about 2023. New car inventories continue to improve. This momentum has continued, starting XPEL off to a good start to the year, they commented. So in terms of revenue guidance, management came out saying Q1 revenue to be in the range of 83 to 84 million. That's about 17% year over year in aggregate. That is assuming still China is down 20% year over year. Most of the regions like the US obviously growing at 20% plus. That's what they're looking for in terms of the quarter. Now, if we look at it, my conclusion here quickly today would be new car inventory continues to improve. It remains to be seen the ultimate impact of higher interest rates will have on new car sales, but new car buyers right now still seem to be resilient. It's likely because of some pent-up demand. Product hasn't been there for quite a while. In inventories have been weaker. I mean, myself, I went out to look at a vehicle and I couldn't even view some of the vehicles that I wanted to look at. So we're starting to see that get into a better state right now. XPEL the company has enjoyed a compound annual growth rate of 38% since 2012, growing from 10.7 million to 258 million at the end of the prior year. Perhaps the most important thing, as we don't always see this in businesses with this strong top line growth, XPEL has scaled its profits alongside revenues and growth. Gross profit and operating income margins have grown over the past 10 years significantly. The company has also produced tremendous per share growth, as well as the share count in the past 10 years has only grown by 1.8 million shares. That's about 7% of the company's shares outstanding if you go back to 2012. So that's how it's growing, but also on a per share basis. A valuation perspective right now, XPEL trades at about 31 times next year's estimates. The consensus is about 208 in terms of earnings per share next year. We see that consensus is a little bit high given the more uncertain macro environment. As such, our estimate, we have it closer to 35 times EPS for next year. We know the business well, continue to hold XPEL, but we are not aggressively buying more shares in the near term as it seems closer to fair term value. If I was looking 3 to 5 years forward, we expect XPEL as a great operator continue to be a long-term holding. So we see it as a long-term holding going forward. We're just not aggressively buying in the near term given the macro environment.
So do you recall what price multiple off of earnings we were initially paying when we bought the business back in 2018 or 2017, late 2017? Do you recall?
Yeah, I think that it was trading in about the 17 times, but that was reported earnings. But the issue there was some what we'd call hidden earnings. There was some. They did a consolidation of some of their facilities back then, brought them under one roof. So there was going to be some cost savings, some one-time numbers in a couple of quarters preceding this. Basically, we had them at around 10 times roughly, right? Mm-hmm. In that range, what we would call normalized earnings. So, that can be your opportunity. You look at, a screener is going to give you 17 to 20 times. But, you look at the numbers, and this is what we're able to do, and look at the income statement, the cash flow statement, and figure out that, in our opinion, on a normalized basis, they're trading at closer to 10 times. We expected 25+% growth. We actually expected higher, but we're modeling kind of 20 to 25% to be conservative. And the company hit it out of the park over the course of the next year. We actually, it was in March. The company sat there in the $1.40 to $1, about maybe $1.50 to $1.25 range for about 4 to 6 months. March, they came out with just tremendous earnings growth. The numbers that we expected came out. They even bested those. We reiterated our buy after the stock went from about 140 to 250, just saying it was actually cheaper on a reported earnings basis then than it was at 140. Because of the fact they had tremendous earnings growth. So bought more at $5, and the company continued to execute. The good thing about management with XPEL too is when we talked to Ryan Pape, who's the CEO, the CFO is great as well. If they think there's a quarter coming up where they have some weakness in China, they're not going to hide that. They're going to tell you exactly about that. They tell the market that as well, which is great to see. So, they're going to give you the good and the bad, and they've just been great operators. And that's what we'd like to see. So one of the, you recommend a company. We actually followed them for 4 years before we recommended it. But when you do a recommendation on a company, you're always, after the fact, you're putting a note down. They told us, for example, 10 cents per share in the next quarter. If they hit 9, you're going to have a negative mark in your ledger on that company. If they had 10 or above, you're going to check it off, and you get more certainty in terms of with what they tell you going forward and what they tell the market going forward. So XPEL keeps giving us checks in the box for the most part, right? And that's what you can hope for. And, in terms of, do we trust management if they come out with guidance? We have a higher level of trust from this team than many out there because you have experience quarter after quarter after quarter, and it's more important year after year. You can have fluctuations in a quarter, but year after year, if broadly speaking, if what they've talked about comes to fruition, you have a higher level of confidence in that. And then when they come out with earnings, you can trust that and model based on that. The flip side is obviously the opposite, right? And so you get into a situation where management, even if everything looks tremendous, if they've missed estimates for a couple of quarters or periodically over a 4-year period, once every third quarter, it's not a good quarter. I was going to say they're pooping the bed or something else, but then you have no confidence in the level of or in their guidance, so you just can't effectively model the company out. So, if you get a company that continually hits, then you have a higher level of confidence. And even if it's trading at 25 times earnings, but if you expect them to grow at 25% because management keeps hitting that, then you can certainly pay a premium multiple, but you can't pay that if the opposite is true.
Exactly. And that's kind
of a good way to look at a business.
I wanted to say, just like look at that multiple expansion that we saw from a company going from just breaking into profitability to all of a sudden, compounding year over year of like you said, 38% CAGR. I don't know how long that was. And then also growing, EPS. Like it's crazy, the multiple that a company can come to demand in the market as, it has this great track record. And then of course, like when the company did report these most recent results, it did kind of spook the market, of course, as, they're kind of wondering, can this growth rate continue? Which, the stock did take a hit, but, still a great.
Yeah. I mean, we've seen in the past, like they've come out with, they've had a quarter where they've had issues in China and then it's recovered completely.
Essentially, and that's
from that.
It's not something.
The only issue would be, I guess, sorry, not to cut you, but I'm going to anyways, but sorry. I was going to, before I forget, I'm older than you, right? So you never know. I might just forget what I was going to say, but in a quarter, they could say in China, they're going to have an issue, but, if they don't recover, and if it keeps happening, then you start to put a negative in the box, but they have in the past done that. The issue in the past, not the issue, but, in the past, they had said, okay, we're going to recover in the quarter. They weren't trading at these absolute premium multiples, right? Say 3-4 years ago. So, we have a quarter that misses and trading at premium multiples. Well, if there is a miss and you're trading at premium multiples, no matter how quality a company you are, we typically see a hit to the share price, right? We expect them to recover. There's growth in other areas. They keep expanding. It was protection film primarily for years for vehicles, right? Now they've brought on, architectural film. And so they're trying to grow that business, I think, 25% organically. And so that's good. If they can continue to do that, there could be other expansion.
Yeah. And it would be different if like something fundamentally changed to like the business itself, where again, like the reason we're kind of seeing a slowdown in China is just because we saw, them kind of revert back into more of a lockdown phase. Anyways, we can
it's the opposite.
Or was it the opposite? Sorry, was it because they opened?
Yeah, it kind of shocked the market you're going to an opening market, right? And then suddenly, distributors have to get product in, and there's a number of things that have to. The economy doesn't start up like that.
Exactly.
So I mean, but the thing you were talking about too, just the tremendous thing that's led to tremendous gains in the share price, revenue growth, tremendous. But like profit growth, just operating leverage, the continued uptick margins it's such a powerful way. That's how they've gotten to a higher multiple over the long term too, because they continue to work on SG&A. They continue to, get more operating leverage the bigger they get, and replicating that model. Like it's like a Boyd taking their model into this market, into a new market. But the companies in Canada and the US, then they move to Europe, then they move to Mexico, to China, and through other areas of Asia, and they just keep, using a similar model that XPEL I'm talking about now in different countries, and they're doing tremendously well at it, and it's it is very well run. So
and the thing is nice when you're partnering with these people who are basically like putting on the wrap for you, it's pretty easy to expand that way.
Yeah, and now they're going close to the customer, the strategy where they're owning the installers, right? Yeah. And they just released a new software. I mean, it's awesome. It's a well-run machine. It continues to oil the machine well. It continues to increase in terms of profitability, and we expect that to continue. It's just been at a premium price for a little while here, so I'd love it to come significantly on sale. I know it sounds always hard for, an investor that's in it right now to say, but if it comes off 25%, maybe you really want to buy some more if they continue to fix that growth rate over the course this year, which we expect them to do. The one thing it keeps you up a little is higher interest rates. I mean, if people just stop buying cars, it'll hurt the company in the near term.
Yeah.
Then we'd probably get a chance to buy some more.
I'm still kicking myself. I didn't buy any at $16 during 2020.
You should just keep kicking yourself.
Yeah.
You learn from the pain, right?
Yes, yes. Anyways.
It's true. So Tricon, we got to move on to Tricon.
Yes.
Brennan, you've got this one, a client. Do you want to read the tweet or email or what? I don't even know where it came in.
It came in
somewhere
on Twitter. It was a direct message. I kind of I paraphrase it here, but he's wanting us to look at Tricon Residential. He indicates that it appears to be trading at a discount with an acceptable balance sheet and tailwinds at their back with housing shortages and massive immigration inflows. So yeah, let's take a look at the business here. So Tricon Residential Inc., TCN on the TSX, currently trading at a price of about $10.59 and has about a $2.9 billion market cap and a dividend yield of about 3%. So Tricon is a rental housing company focused on serving the middle market demographic. Tricon owns and operates approximately 36,000 single family rental homes and multi-family rental units across United States and Canada. They actually recently got rid of the multi-family rental side of the business not too long ago, which I will get into once we look at the financials there. And essentially, the business primarily focuses on the U.S. Sun Belt region, which is home to about 40% of all U.S. households. And as you can see in this slide from Tricon's investor presentation, its net operating income primarily comes from these high population growth areas. So jumping right to the financials here. So net operating income for the quarter was $73.7 million, an increase of about 24% from Q4 of 2021. Revenue from single family rental properties was up about 45% to $180.9 million. And this was driven primarily by about 23% growth in the single family rental portfolio and a 9.4% year over year increase in average effective monthly rent, from about $1,600 a month to about $1,740 per month. Now, revenue from the private funds and advisory services was down slightly to about $14.8 million, driven by no performance fees being recognized in the quarter, as well as a decrease in property management fees following the sale of Tricon's remaining interest in the U.S. multifamily rental portfolio during the quarter. And on this point, if we look at Q3 of 2022, you can see there, on this point, if we look at Q3 of 2022, revenue from the private funds and advisory services was about $112.5 million, which was inflated due to the accrual of performance fees earned from the sale of Tricon's remaining 20% equity interests in the U.S. multifamily rental portfolio following the quarter end. So I just wanted to, point that out if you guys kind of saw that anomaly and were thinking, what the heck's going on over there? So adjusted funds from operation for the quarter, or AFFO, was up about 143% to $88.7 million or 28 cents per share. And as of December 31st, 2022, Tricon held about $204 million in cash and debt and leases of about $5.7 billion, providing a net debt position of about $5.5 billion and a trailing net debt to FFO multiple of about 23 times. The company also, they don't break out their adjusted EBITDA, but in their investor presentation, they said that they have a net debt to adjusted EBITDA multiple of about 7.2 times as at the most recent quarter. And looking at the debt, about 71% of the debt is fixed rate, while the other 29% is floating rate. So more is fixed, which is good. And on the valuation metric, the company trades with a trailing price to AFFO multiple of about 12 times. So looking at the company's guidance, they did provide some guidance here. So you can take a look at that just on the slide as well. I did want to mention a comment just from the president and CEO, Gary Berman. He says, as we look ahead to 2023, we remain focused on growing our single family rental portfolio so we can serve thousands of more families who are in need of high quality, relatively affordable rental housing. Our guidance for 2023 reflects a gradual acceleration of acquisitions over the course of the year, albeit at a slower pace than 2022. So they are expecting, growth to slow a little bit, as well as strong same home net operating income growth, largely offsetting the impact of higher interest expense in our FFO profile. We are encouraged by the resilience in our January operating metrics, the emergence of green shoots in the debt markets, and stability in the resale housing market that all point to another year of strong operating performance. So, they do have a good outlook towards 2023, despite, what's going on in the economy. So to conclude, I do think that Tricon is an attractive business operating in high population growth areas, trades with a reasonable price to AFFO multiple, pays a nice dividend yield, and has a reasonable balance sheet for a REIT. But, however, if I was to choose between Tricon or the REIT that Keystone, that we have in coverage, which focuses on the Sunbelt region as well, so it is comparable to Tricon, I would personally pick the one that we have in coverage. And the reason being is I'll go over it here. So number one, it pays a better dividend yield despite it actually paying out, more of AFFO for the dividend, but still it pays that nice 3.8% yield compared to a 3% yield from Tricon. It also trades with similar valuation multiples. So both are trading at a trailing price to AFFO multiple of about 2 times. The company that we have in coverage has a more attractive balance sheet. For example, if we look at the net debt to FFO, Tricon's is about 23 times, whereas the company that we have in coverage is about 16 times. And the percentage of debt that is fixed rate is quite a bit higher for the company that we have under coverage at about 90% compared to 71% for Tricon. And last but not least, the company that we have in coverage is projecting similar growth rates for 2022, but growth per share based on AFFO is anticipated to essentially be stronger. So, I do think that it is a good business, but that's really what it comes down to is this the best REIT or company operating in the Sunbelt region that I could choose? Well, to conclude, I would pick the one that we have in coverage. Okay, now I'll open it up to you guys.
Yeah, it's a good summary. I think the issue here is, the guidance, not the guidance, but the estimates out there. I'm looking at a report on the company right now, looking at adjusted FFO per share, around 64 cents this past year, and 44 cents expected next year, or this is 2023, and then 49 in 2024. So, still 2 years out, not exceeding in terms of what you're looking at in this past year's FFO on an adjusted basis. We'd like to see growth there. And like the notes, they talk about from home acquisitions, the increase in financing rates has significantly lowered the opportunity sets for homes, which can be acquired currently for Tricon, generally underbidding for homes to achieve a 5.5 to 6% cap rate target. That's what they're bidding at to achieve that target cap rate. But Tricon they expect to accelerate as the year progresses in terms of home buying should interest rates stabilize in the second half of this year. Again, that's if they stabilize. In many cases, I've heard if they come off, right, it would be a reason they would buy some more. So, uncertainty in terms of where their adjusted FFO goes in the near term, and most estimates are for lower adjusted FFO in this year and next year if you just compare to the trailing 12 months. So that's one of the reasons why you see the share price come down. And, as opposed to the company that we have in coverage that is operating in the US, a lower multiple, like that multiple on AFFO is going to go up this year from this company, even if it stays at the same price. in terms of the units, whereas or the share price is, and the REIT that we're talking about is likely going to have the AFFO come down, the multiple, if the price stays the same.
Exactly. So like even just like looking here, so like off of the guidance, and again, these aren't directly comparable because we're looking at like core FFO growth for Tricon, and then AFFO or adjusted funds from operation growth for the company that we have in coverage. So Tricon's looking at a 25% decrease this upcoming for 2023, whereas again the company that we have under coverage, they're still looking at growing AFFO, which is nice to see.
Paying the same price. So
exactly, and potentially less risk too, so again,
it's always good you bring up Aaron's picks. This was a company he was doing research on when he's not here to take credit for it, so he can't push back.
This is true. This is true. You probably ripped my segment apart, eh? Yeah.
No, I think. Well, he recommended the mystery company that you're talking about, so he'd be saying, "Oh, Brennan, great work, great work."
It sounds exactly like him too.
Yeah, well, last week I was ripping him for not getting the cash balance correct on Dynacor the week before. So, there's I mean, he got it correct. It just was in a different currency, right? So,
yes.
I mean, Aaron gets ripped enough.
Half points.
Oh, he was talking about the right company, just the wrong currency. But I'm kidding. And I can say that because he's not here today, right? So, although I did say it when he was on the show too. So. Oh, poor Aaron. I hope he's having a good time. I heard nobody's speaking the language to him down there right now, so he's just basically sitting in a corner. Although Aaron does know some Spanish, so Although I think it's the dialect in the area that he's in that he has trouble with too. I mean, I may be making that up, but I'm pretty sure he's told me that before. All right, so I think that ends it for this week. I thank you two guys for co-hosting with me. Keep your questions coming into our Your Stock Our Take segment. If you've got two companies you want us to compare, send those in. Now, and if you want to rate us and review us on iTunes, do that. Smash the like or the whatever button on YouTube on our channel there. Smash that sucker right now. And subscribe to our YouTube channel, and we'll keep putting out this content on a weekly basis. Thank you. And as always, I wish you profitable investing.
Thanks, everyone.
Thank you. Profitable investing.